Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Tony Zhang. He's the Chief Options Strategist with Options Play. We're going to take a look at the U.S. options market in review in what's been a dot-com world. Tony, it's great to have you with us as always. Thanks for joining us on Trade Talks.
Yeah, thanks again for having me. Really excited to talk a little bit about what we've seen that has changed over the last few weeks and really how we're positioning for this market post-COVID-19, especially with some of the changes in the options market recently.
Yeah, for sure. And let's go through a couple of your slides here with a brief market overview.
So first of all, what we're looking at when we're looking at the overall market, one of the things that's clearly changed is the bulls have started to take over, because over the last month or so, there's really been a bit of a battle between bulls and bears around that 285 level on S&P. And we're starting to see the bulls start to take control here. And not only if we look at the S&P, if we also look at the Nasdaq 100, now only less than 400 points away from its all-time highs. That's pretty incredible to see that type of return, partially because it's driven because of technology leadership that we've seen so much over the last few months, but also because the Nasdaq 100 index doesn't have any financials in it, which has really been one of the sectors that have been dragging down the overall market. So technology leading this move higher. However, we are also seeing leadership broaden out as well, because originally we were just seeing the mega cap, super cap stocks that were dragging this market higher: Amazon, Facebook, Apple, Microsoft. But now we're starting to see small caps join the rally as well. So this is all supportive of this bullish move that we're starting to see, and we think S&P is going to start testing 300, 302 on SPY and possibly even break out higher. These were levels that we simply did not think we were going to get back to at all even a month ago.
All right, and Tony, in terms of volatility, what are you seeing there?
So the VIX is actually one of the things that's very interesting, because last week VIX almost went back into backwardation very quickly on Thursday morning, but quickly reversed back. So we're back in this risk-on environment. And now with VIX below 30, what this really actually changes not only is our positioning for the markets in terms of being bullish or bearish, but also what option strategies we deploy. So for the last month or so, with VIX being relatively elevated compared to January and February, we were predominantly selling options, selling premium credit spreads predominantly in a lot of the names, especially when there wasn't a strong directional movement. Now that the bulls have started taking over this market and we're starting to rally a little further, and there's a lot more momentum. If you see stocks like Facebook today that has reached all-time highs, and VIX being low, we're actually looking at buying premium now as a way to continue to play for upside, but do so in a way with actually a small amount of risk. So some of the trades that we're looking at here today is more focused more on buying options and doing so in a way where we're risking the least amount of capital. So because, on these subsequent rallies, there are signs of exhaustion. There are, and the fact that we're trading at peak valuations is concerning for a lot of people as far as going long. So using options right now is a great way to continue to gain that long-term bullish exposure, but more importantly, do so in a way with relatively small amount of risk.
And Tony, before we get into your trades here, I just want to take a look at the fifth slide, because you can really see the bifurcation in the market. And I think that's important to point out as we talk about this week, looking at newer highs within the market, which is something that we wouldn't have even suggested just 6-7 weeks ago.
Exactly. So this is some of the data that we've been looking at over the last few weeks, and we just wanted to provide an update. This is data from Bank of America's credit card data. But one of the first things that we notice is that even during the lockdown, when spending overall was down, online spending accelerated, which was not necessarily a surprise, but we continue to see that accelerate even now, specifically in certain categories like online electronics, online retail. Those are two categories that have seen substantial growth in this. But also, if you look at the portion of spend, that's doubled from online spending, which normally is about 15% of spend, has now doubled to 30% and has stayed there. So this is really how we're looking at positioning post-COVID-19 in terms of within each sector. There are companies that focus more on a digital and e-commerce strategy and ones that do not. We clear bifurcation in the markets for even within sectors. So that's how we're really looking for opportunities going into post-COVID-19.
All right, let's take a look at our first trade here with Uber. Certainly has been in the news as it's looking to make some acquisitions in the food delivery space, which certainly has picked up since we have enjoyed this lockdown.
Exactly. So Uber actually has quite a few different tailwinds that I think work in its favor post lockdown. Number one, obviously, as we get back into potentially working, not everyone feels comfortable getting back on a train. Some of the things that you and I have discussed. So perhaps people are more likely going to be taking Ubers just purely as a transportation. But as you said, Uber has diversified their business into food delivery as well as grocery delivery. So those are two components that we think are going to provide a support for this name compared to some of the other ride sharing names. So that's why we actually quite like Uber going into this. So one of the ways that we're looking to play this, as I said, the valuations are at pretty stretched valuations. So it is for many investors uncomfortable to continue to go long at these prices. So we want to utilize options, and specifically debit vertical spreads allow us to take a directional view with the least amount of risk possible. So in this particular case, I'm looking out to July. I'm buying a 35.42 call spread here, costing me only about $220 for a $7 wide credit spread, which gives me a risk to reward ratio of about 2.5 to 1. So if Uber does rally up to 42, which is the Bank of America analyst target price on this, we're looking at about a 2.5% return, and you're only risking about 6% of the underlying stock price. So if things really start to turn around, if let's say there's a second wave and we go back into lockdown and all stocks sell off again, I'm only risking 6% of this underlying stock price to take this type of trade.
All right, let's go along to our next trade here on Walmart. And that's something that you had brought up before. And I'm curious to see exactly how it plays out with retail as economies start to open up, because with Walmart performing so well, particularly on the digital side and also order online, pick up at the store, that's really where we saw the outstanding metrics. It makes you wonder if people are going to continue with their shopping habits that way, at least in the near term, until they feel more comfortable going back into individual retailers, because now it's a matter of convenience.
Yeah, exactly. So even before COVID-19, we started to see this bifurcation within retail for companies that have invested in a digital and e-commerce strategy, like Amazon, Walmart at the front of that, and retailers that did not. And I think one of the best examples is really Dollar General and Dollar Tree, which for many years traded in very lockstep as discount retailers. But Dollar General started investing in a digital strategy a few years ago and really has started to outperform. So this is really where we see Amazon and Walmart be the front runners here in this particular space. So that's why I'm looking at Walmart, which does trade, in my opinion, at a much more reasonable valuation. So the same thing here, we're going out to July, we're looking at the 125, 140 call spread here on Walmart, which only costs $4.49 for a $15 wide credit spread, which again gives us a little bit more than a 2-to-1 risk to reward ratio as if Walmart does continue moving higher up to that 140 range. But the key here is that this is only risking about 3.5% of the underlying stock price. So, even if you do have a second wave, I don't think Walmart is the type of stock that will sell off very heavily as it did not during the first step. So we really like this type of name, especially as we think consumers are not going to be quite comfortable enough to go out there and go out to stores. They're predominantly still going to rely on more online delivery and these types of e-commerce retailers to provide their goods.
All right, and our third and final trade of the day, tobacco. We haven't looked at that sector in quite some time.
Yeah, so one of the things that we talk about quite a bit here at Nasdaq is really ESG, and I think ESG is going to be a factor for investment going forward. And tobacco certainly falls into one of the categories that does not perform very well within ESG circles. So tobacco, given the fact that COVID-19 has hit these tobacco stocks fairly strongly, and they have not rallied back like the rest of the markets, showing incredible amount of weak relative strength, we're looking at potentially some short opportunities here in names like tobacco, like Philip Morris. They do provide a pretty strong dividend yield, so there's two ways to play this. You can buy a put debit spread like the one that I have here, which is again going out to July, looking at a $70, $60 put spread costing me about $3 or so. This again gives me more than a 2-to-1 risk to reward ratio if Philip Morris does revisit back to those March lows back around $60. But again, I'm only risking here about 4% of the underlying stock price. If tobacco does somehow rally, which I think that there's limited reasons for these types of stocks to continuing rallying, you're only risking about 4% of the underlying stock price. So the key here is really just volatility starting to come down. We can buy this type of convexity and premium for a much lower price than they were even a few weeks ago. And this allows us to take these different types of directional views that we have while risking a small amount of capital.
All right, Tony, how can we get in touch with you at Options Play?
Yeah, so thank you so much for having me. But for everyone that's here that's watching, you can sign up for a free trial for the Options Play software that I just showed you to look at these types of trades. It gives you a free 30-day trial with daily trade ideas, as well as bi-weekly market outlook sessions, which gives you an expanded version into what we're discussing here today, which is what we see with the markets, what trade ideas we currently have, and how we're positioning for the markets. And you can sign up for free at trade.optionsplay.com/trade talks.
All right, Tony, great to have you with us as always. Thanks so much for joining.
Thank you so much for having me.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.